Welcome to Commercial Bank Management Finance 4324 here at Keiser University. This is part one of the week one live chat. And of course, I'm your professor, Dr. Mark Dennis. In this first session, we'll begin with the foundations of banking, focusing on material from chapters 1 and 2. Our goal, of course, is to make these concepts clear, practical, and directly connected to the financial systems that we interact with practically every day. Let's start with the definition of a bank. A bank is any business that accepts deposits, which can be withdrawn on demand, and which also makes loans of a business nature. That's the simple definition, but it has quite a few layers. Economically, banks provide essential services, including safekeeping money and lending it out to fund business growth. Legally, their very existence is built around offering deposits and making loans. At the core, banks are the principal source of credit in any economy. In fact, in the United States, banking assets account for about 1/5 of all total assets held in the country. Here's a powerful quote. Modern banking has been one of the greatest contributors to human progress. Think about this for a moment. Before modern banking systems, widespread poverty was the norm, even in more developed societies. With banking, businesses could access credit, take reasonable risks, and of course expand their operations. That leads to faster growth, more jobs, and innovation across every industry. So yes, it's true, banking can be misused, but when managed well, it has been transformative for raising living standards. How do banks actually make their money? Their primary source is interest income. Banks collect deposits from customers, pay interest on those deposits, and then lend the money out at even higher rates of interest. The difference, what they pay out versus what they bring in, is called the spread, and that spread is their profit. Beyond that, banks earn fee income. Think about service charges, cash management, or wealth management services. Fees have become an increasingly important revenue stream, especially as competition squeezes interest spreads. What's the role of banks in the broader financial system? At the highest level, banks encourage saving and then transfer those savings to borrowers who need credit to invest. That cycle drives economic growth, creates jobs, and improves living standards. Alongside this, banks provide supporting services like payments processing, risk protection, and liquidity services. When you use your debit card, take out insurance through a bank, or tap into overdraft protection, these are all examples of supporting services. Now let's look at the sizes and categories of banks. Size is typically measured by assets. Small community banks, regional banks, and large money center banks all play distinct roles. Regulators also classify banks based on systemic importance, domestic or global. You'll hear terms like SIFI or SIFI, DSIB, and GSIB, all of which we will unpack in just a few moments. Community banks are the smallest, with less than $10 billion in assets. They primarily serve local communities, offering personalized services. They may have narrower product lines, but the customer connection is often stronger. Employees tend to learn all aspects of the bank, and customers appreciate the local touch. Regional banks fall in the mid-range, with $10 to $50 billion in assets. They cover wider geographic areas and expand their product lines, things like wealth management, investment services, and credit cards. They often serve as correspondent banks and may grow by acquiring smaller banks. Money center banks are the giants with more than $50 billion in assets. These banks are usually headquartered in major cities and have national and even international reach. They offer the broadest range of services, often through holding companies. They're well diversified, capable of withstanding market volatility, and sometimes they are labeled as quote unquote too big to fail. Now, on to regulatory categories. SIFIs, or statistically important financial institutions, are banks or insurance companies whose failure could trigger a financial crisis. These institutions face stricter capital requirements under Basel rules. Domestically important banks, or DSIBs, are identified by national regulators as being critical to the domestic economy, while GSIBs are globally recognized as critical to the international financial system. Similarly, we have DSIBs, systemically important banks. These include banks that may not be global players, but they are essential in their home markets. They undergo annual stress tests to determine their ability to withstand any potential economic shocks. As banks grow, their structure and organization become more complex. Small community banks may be relatively simple, but as asset size increases, so does the range of financial services and the number of departments involved to provide those services. Broadly, banks can be categorized as insured banks, state-chartered banks, nationally chartered banks, and member banks. In terms of organization, you'll encounter unit banks, branch banks, holding companies, and increasingly electronic banks. Let's take a closer look at legal structure. First, we have insured banks, those who are covered by the FDIC. Then there are state-chartered banks, which operate under the authority of an individual state and are supervised both by state regulators and the Federal Reserve. Nationally chartered banks, by contrast, are supervised by the Office of the Comptroller of the Currency, or OCC. Finally, member banks are institutions that belong to the Federal Reserve System, which requires them to hold stock in the Fed. Next, there is the physical structure of banks. At the simplest level, we have unit banks, just one office serving the community. Then branch banks, which extend reach into different locations. Holding companies own one or more banks, and electronic banks are those that primarily deliver services digitally. Unit banks are the oldest type of bank. They consist of a single location where services are offered. While they may have ATMs or drive-through facilities, the hub remains that one office. Many new banks, often called de novo banks, start out as unit organizations. Customers often prefer these smaller banks because of the personal relationships and the community feel. Branch banks came about as a way to extend reach. By opening facilities in new neighborhoods or towns, banks could attract more customers and offer more convenience. While branches typically provide a full range of services, sometimes they focus only on retail functions like tellers or personal banking. With technology, branches are not as critical as they used to be, but they still play a key role in customer interaction. Holding companies take banking a step further. Holding companies are corporations that own banks and sometimes other businesses as well. A holding company may own just one bank, or it may control many banks. They are often formed for tax advantages, funding flexibility, or simple diversification. A financial holding company, or FHC, is a type of holding company that can offer a broader range of services, such as insurance or investment banking. Today, many of us rarely step inside an actual bank, all thanks to electronic banking. Services are delivered online, through ATMs, mobile apps, and call centers. Younger customers especially prefer these methods, but nearly everyone uses them. Electronic banking has transformed how we interact with financial institutions, thus making services available 24/7. When we think about how banks deliver their products and services, we call these channels. Channels reflect the way customers interact with banks through physical branches, ATMs, online platforms, or mobile apps. The choice often depends on factors like age, trust, location, and of course personal preference. Modern banks must provide multiple channels to meet customer needs. ATMs are one of the most familiar banking channels. They allow self-service functions like withdrawing cash, making deposits, transferring funds, and checking on balances. Many ATMs today are quite interactive, connecting customers to a remote bank representative in real time if needed. They're located in bank lobbies, drive-up kiosks, or inconvenient off-site locations. Of course, ATM usage often carries with it fees, especially when using machines that may be outside your own bank's network. Inside the bank itself, there are different internal structures. On the sales side, we see roles like the Chief Lending Officer, Relationship Managers, Credit Analysts, Branch Managers, Personal Bankers, Tellers, and Wealth Managers. Each of these roles is focused on serving clients directly, whether through loans, deposits, or wealth services. Supporting these sales functions are operational teams. The Chief Operations Officer oversees areas like loan operations, deposit operations, trust operations, and branch operations. Marketing also plays a role, as do specialists in credit administration and loan workout management. Without strong support teams, the frontline sales staff could not function effectively. Administratively, banks have structures that look similar to other large corporations. At the very top are the CEO, the COO, and the CFO. There are also other senior leaders in legal, human resources, IT, and risk management. These roles may not be customer-facing, but they are vital to the health of the bank. On the governance side, the board of directors has its own committees. The nominating committee, for example, puts forward candidates for board seats. The compensation committee approves officer pay, including CEO compensation. The risk committee monitors organizational risks, while the audit committee reviews the results of audits and regulatory exams. These structures ensure both accountability and oversight. This concludes part 1 of the Week 1 live chat. As always, anytime you have questions about the course and course content, feel free to reach out to me via voice, text, or Keiser email. In the meantime, keep pushing forward, and I'll see you at our next session.